Good evening, everyone. I want to welcome you to our presentation tonight. We'll start in just a moment. We're just going to allow our guests here to join in. While our guests are joining in, I just want to bring your attention to this poll on your screen, which best describes where you are in your career. This will help us shape our presentation today and shape the conversation topics. Perfect. Getting some responses here. Alrighty. So mix of everyone here. That's great.
I like the none of the aboves.
Yeah. Awesome. Well, let's get right into it. Good evening, everyone. My name is Jake Giesler. I'm an advisor here at TMFD Financial. I'd like to start off by thanking you all for joining the webinar this evening titled The Dental Practice Financial Playbook. In a moment, I'll introduce our presenters for this evening. But first, I'd like to give a quick intro to TMFD for anyone who's new. Our goal is to make the financial lives of our dentists simpler. We bring tax, investments, insurance, and other financial planning matters under one roof so you're not coordinating between separate providers. In our experience, we found that providing a one-stop shop for financial solutions provides clients with the comfort of knowing that all aspects of their financial careers are synchronized. The result is simplicity, peace of mind, and confidence in your financial decisions. If you own a practice, we do a practice assessment that gives you a clear picture of its financial health, where things are strong, where you might be overspending, and what it's worth in today's environment. It's something we include for our clients, but if you haven't had this done and you're curious, just let us know. For associates thinking about buying a practice, we can help you work through whatever the numbers make sense. We'll look at cash flow, loan repayment, and identify areas of strength and potential areas of concern within the practice. We've helped a lot of our dentists through this on both sides of the transaction. And before we get started, I want to take a moment to run through a few housekeeping items about this webinar. We're scheduled to go to about 8 p.m., and if you have any questions for our presenters during the presentation, please ask them in the Q&A section at the bottom of your screen, and they will be answered at the end of the presentation. If you have any questions for me behind the scenes or something you'd just like to comment on, please feel free to send a message in the chat box. CE credits will be sent out in the next 2 weeks following this webinar, no later than March 26th. And lastly, we encourage you to register for our TMFD Dental Academy mailing list so you can stay up to date with all of our future upcoming webinars. Well, that's all the housekeeping items I have for today. Now I'm excited to give a warm welcome and introduce our speakers for this evening, Stive Farronato, Josh Belliveau, and our moderator and guest, Dr. Neil Gajjar. Stive Farronato is a chartered accountant, certified financial planner, and avid Leafs fan who has dedicated over 3 decades into helping dental professionals navigate the complex financial landscape of practice ownership. Since founding TMFD in 1995, Stive has specialized in advanced tax planning strategies for dentists, from incorporation timing and practice acquisitions to succession planning and wealth building. His unique background combining public accounting, firsthand experience with CRA, and a deep specialization in dentistry allows him to provide integrated strategies that address both their practice and personal financial goals. Josh Belliveau is a senior financial advisor and certified financial planner at TMFD. Josh works with business owners, retirees, and families who need guidance through complex financial decisions. He believes in an integrated approach that always brings every aspect of a client's financial life together, ensuring that they have their unique goals in mind. Since each decision can have a ripple effect across the broader financial picture, Josh focuses on thoughtful, well-rounded planning. And last but not least, I'd like to introduce our moderator for this evening, Dr. Neil Gajjar. Dr. Gajjar is a distinguished general dentist and dental educator with deep roots in academic excellence. After completing his chemistry degree with faculty scholar honors at the University of Toronto, he went on to receive his Doctor of Dental Surgery degree in Washington, D.C. Beyond his practice, Dr. Gajjar has been deeply involved in advancing the dental profession. He has served as the president of the Academy of General Dentistry in Chicago and past president of the Ontario Academy of General Dentistry. He's also lectured extensively on medical emergencies in dentistry and has served as a clinical instructor at the University of Toronto's Faculty of Dentistry, where he has helped train the next generation of dental professionals. Dr. Gajjar, from all of us here at TMFD Financial, we thank you for your participation. And with that, I will turn things over to you guys.
Jake, thank you so much for the warm introduction. First of all, I'd like to welcome everybody taking part in this webinar tonight. Thank you for taking time out of your schedule. Usually, we're taking a lot of CE courses for the benefit of our patients, for the benefit of our practice, for the benefit of our staff. Tonight is about you, how you're going to benefit, how you're going to improve your life, and potentially how you're going to retire very successfully. We are going to go through all those stages. We're going to be moderating the discussion towards that. And in full disclosure, I'd like to let the audience know that I myself am a client of TMFD, been so for almost 27 years. And the fact that Steve still supports the Leafs, now I know 27 years ago why he took me on as a long shot client. And we are very grateful for that because it's been a great partnership, and they have not only helped me a lot, but have saved me a lot, both in terms of money and in terms of other things. So with that said, I think we can dive right into it. We will start the presentation. Jake, if you can flip the first slide. We've gone upon ourselves to kind of structure this a little bit. We are scheduled to go for an hour. However, we will go later. If you do need to drop off, we do completely understand. And you will get your CE credits. If you do want to stay on for a little bit longer and ask questions, we've opened up our whole evening for this, so we'll be more than happy to do so. So, with that being said, let's start off with the first question that many have posed. As an associate, when does incorporation make sense?
Always a question we get a lot of the time, right? We attend a number of the UFT events and the ODA events, and we speak to a number of associates, and we get it all the time. But basically, as it comes down to, incorporation makes sense when you have the ability to defer and save some dollars inside the corporation. If you're in a position where you are pretty much spending all that you're making in lifestyle expenses, whether it's family, whether it's paying down school debt, then an incorporation doesn't really make sense. The idea of setting up a corporation so you can write off a number of expenses, that is a bit of a myth. The expenses are deductible whether you're incorporated or not incorporated. And Jake, if you go to the next slide, because I'm an accountant, we love numbers, so we provided a bit of a numerical example. We made a couple of assumptions that people obviously are in Ontario, and the corporate tax rates for a dental professional corporation is around 12%. We've assumed a marginal tax bracket around 47%. It isn't the top tax bracket. The top tax bracket in Ontario is about 53%. But in this situation, we have an associate making $250,000 a year. Obviously, he has a couple of expenses that he can write off, but really he only needs about $150,000 to live. He or she has made the decision that that is the figure that their family requires. So here we have an ability to leave some money inside the corporation, and you see a pretty good dollar level, about $88,000 is left inside the corporation to either pay down debt or invest or do other things. By not incorporating, you are giving a good portion of tax dollars to CRA, and that is not a partner you want to have.
I'll throw some things in here too, Steve.
Sure.
From a planning perspective, when you're right out of school and if you have a lot of debt and you have goals, short-term goals that don't align with incorporation, sometimes you want to take your income, write off all your tuition credits first, then incorporate, because the sooner you incorporate, the sooner you have to incur costs of filing corporate tax returns versus self-employed. If you want to save for a home, there's a lot of mechanisms you can use or accounts you can use to offset tax, like RSPs as you build room for the home buyer's plan. You can have the first home savings account, which is fairly new now in Canada. So there's lots of things to consider before you incorporate. Those are mainly the ones that we see, paying off debt, student debt, and saving for a home, because those are usually the two top priorities when you're younger and you're looking to get a home and get debt free, at least from a student perspective.
Good point, Josh. And what I'd add to that one more is we see sometimes a lot of students get out of dental school and the first thing they do is they decide to incorporate. And again, there's cost to incorporate, there's cost to have an accountant do tax work and filings. And if you're not really seeing a benefit to saving some dollars, then it really is not going to work, right? So save yourself some dollars, speak to a professional, see if it makes sense. On to the next question, Jake.
So one question with the incorporation, I think we might get into it a little bit later, is family shareholders in the corporation. Is that a slide that we're going to deal with later on?
Yeah, Neil, I think we're going to talk to a little bit in terms of when we come down to structure.
Okay.
And who benefits from having multiple levels of shareholders.
Perfect. Sounds good. Okay. So then we go on to, we're still in the associate stage of life. And so one of the questions that's always, and I'm assuming this is when you are incorporated and you're working in that corporation, that, you know, are you going to draw a yearly salary or are you going to pay yourself as dividends from that corporation? Now, is there an advantage to one over the other? I know if you're paying yourself dividends, then you don't have to pay yourself CPP. So that's obviously a big savings off the bat. But is it worth paying CPP? So
no, all good questions, Neil. I mean, this is again another one of the standard questions we get, because there are really two different ways to pay yourself, either a salary or a dividend. We won't get into things like shareholder loans and stuff because it's another touchy area, but we'll get into some of the basics of salaries and dividends. A salary, as Neil had sort of pointed out, gives you the ability to contribute to Canada Pension Plan. You don't contribute to unemployment insurance because you are ultimately in a situation where you can't lay yourself off. But Canada Pension Plan is a program where obviously you are paying into it, where at retirement there's going to be some dollars available to you. Assuming the Canada Pension Plan, which is currently strong, it's been funded quite well over the last number of years and continues to be funded, and it's run quite well in the last number of years. They got an independent board, and the money seems to be pretty healthy. It also creates RSP room, so you can contribute to your RRSP as well too. With dividends, you don't generate RSP room. You may have a little bit extra money to save in comparison because you're not contributing to Canada Pension Plan. But as I was speaking with Neil a little earlier today, there's no real right answer whether it's salary or dividends. If the CRA made it such that a dividends or a salary was going to be so much more beneficial, then everyone would lean that way. The tax integration, the combined efforts of employment income or self-employed income or corporate tax and corporate income, it's all going to be roughly the same amount of tax that you're going to pay at the end. It's about the same. There's a slight marginal difference. But, there are other factors like the Canada Pension Plan. Again, I had a little story that I was talking to Josh and Neil earlier about Canada Pension Plan and people's fear of the money not being there. My dad's a 92-year-old Italian man. Unfortunately, had to retire relatively early at 57. CPP only started in 1966, so he only contributed for a number of years, but now he's collected, close to 40 years of Canada Pension Plan. Now, when I was talking to him the other day, I said, Dad, you definitely have benefited from the Canada Pension Plan program, and you can thank me and my colleagues at work for their contributions to the plan. So it's been good for him. I know, Josh, you had another story where it is a little different on your end.
Yeah, I have a story that's the opposite end of that spectrum. My father-in-law passed away 8, 9, or 10 years ago, and he contributed to CPP for probably 30 plus years, employer and employee contributions, because he was a business owner. And my mother-in-law worked a number of years after he passed and collected the CPP survivor benefit, and everything was great. She got the maximum benefit. And then she decided to retire a number of years after that, and she started collecting her own CPP. So they both paid into CPP fully. She basically gets very little to nothing of the CPP survivor benefit from my father-in-law. So there's both tales there of good and bad. I do like CPP from a forced savings point of view, but there's a lot of planning that has to go into it on the back end. If you're a family with two spouses with CPP, you might want to take that earlier rather than later to mitigate that CPP survivor benefit maximum ceiling. It's a planning item. Doesn't mean you plan your whole life around it, but I do like CPP from that point of view.
Yeah, I think, Josh, a lot of the myths out there, people misconceptions is that you think you're going to collect 2 Canada pension plans when you retire, and then unfortunately your spouse passes away. You think you're going to be collecting their survivor benefit, and that's not the case. You only collect it when you're working or you're not collecting it and your spouse unfortunately passes, but you don't collect on both, which is a sad situation.
Yeah,
I know a few years back there was some discussion regarding this, and there was some, I guess, some doubt as to, if I'm working in my office and I'm not taking any type of salary and just a dividend, would CRA ever come back to me and say, hey, you're working, why aren't you contributing to the Canada Pension Plan? Whether you need it or you're not going to get it or whatever, you still have a legal obligation to kind of contribute. Is there any validity to that? Is any test or anything that they've known anything that they've come back for that?
Not really, Neil. I mean, as a business owner, which is the benefit of being incorporated, you have the decision or the ability to decide how you compensate yourself.
Okay.
Right? Whether it's a dividend or a salary, it's your choice. Right? So CRA really has no sort of say to it. They're getting still their share of taxes, whether it's through the corporation or individually. So they're not losing out. Let me tell you that. All right.
Okay.
There'd have to be a change to the Income Tax Act on dividends and how it's applied to CPP. So
well, with Carney, you never know. We might
never know.
people who retire, so
opinions on this broadcast will be that of the individuals themselves.
That is correct. Yes, yes. Well, we almost went through that with capital gains recently. So I saw all the accountants out there trying to figure out, should we adjust the cost base right now before we sell, or should we take the hit when we sell, right? So let's see. All right, Jake, let's move on to the next one. All right, so building your foundation. So we're moving on. We're moving up the associate ladder to eventually starting to get incorporated, and then getting close to buying a practice, I'm assuming. So Steve, you want to talk about this a little bit?
Yeah, I mean, there are a number of things there. I mean, you know what? I'll touch briefly on. Jake maybe will just sort of drop off some of the responses there on some of these things. You know, from what expenses are safe to deduct. You know, this is a very, very broad range, right? I mean, as business owners, you know, we tend maybe to be a little aggressive and write off a number of items. Keep in mind, from a CRA perspective, as long as expenses are reasonable, they were used to produce an income, then they don't have an issue. Where it gets a little tricky or hairy is when people start, writing off 3 vehicles inside a corporation. They want to write off many dining expenses. They want to attend 3 or 4 different trips around the world on professional education. What I tell people is the tax system in Canada is fantastic. You follow the rules as best you can. They generally don't look further into your deductions unless there's a particular reason to do so. So be mindful of what you write off. Again, work with your professional and use them as guidance.
So private jet to a CE course with a couple of friends, colleagues.
The that's not a bad idea.
With your accountant, I'm assuming, right?
Oh, obviously, that's for sure. All I say, just be mindful. That's all.
Stay within certain parameters. I'm assuming is the name
for
of the
sure,
game, right?
for sure, Neil. Yeah. Maybe Josh, you can touch on the other two for sure.
Yeah. So a big decision usually is when you have debt. Do I pay my debt or do I invest first? The immediate answer is if you have high interest rate debt, pay that debt first, especially if it's non-deductible. If it's deductible, then there's a bit of an analysis you could do. How much is the after-tax deduction on the interest rate and what is it true? Now, if you have interest rates that are low, then you might want to invest. The opportunity there is that your investments will do better than the debt that you're paying down. Typically, a blended strategy works better if you have lower interest rate debt and you want to do a balance of saving, investing for the future, and paying off your debt. But there's an emotional aspect to it too, because sometimes debt weighs heavy on individuals. And if that's the case, maybe you pay your debt down aggressively first, and then you attack your savings and for retirement or whatever you want for your goals. There's no real wrong answer here, but if you have high interest rate debt and it's non-deductible, we should probably attack that first.
There's always the coulda, shoulda, wouldas, right, Josh?
Yeah.
Oh,
it's easy to make decisions in hindsight. I'll also talk about the insurance. I might as well jump into that. So I think everyone here knows disability is a must. You go to school for a long time, you spend a lot of money, either family or you take loans or whatever, and you're highly trained and you're going to make a lot of income. You need to protect that. That's your investment. As far as the other insurance, life insurance, critical illness, that life insurance is more if you have dependents or you have loans you need to cover off and you want to make sure if something happens to you, your family's okay or the loans are taken care of. Critical illness to me is more of a want than a need, but some people view it as a need. And that's usually if a life circumstances come up in their family or themselves where they see that. There's 2 more, business overhead and key person. Business overhead is if you have a business, it's like disability for the business. And if you get a disability and you want to continue running your business, that's a good way to meet short-term expenses while you figure that out. Key person is if you have a partnership and you want to cover off each other's families in case anything happens to each other. These are the insurances we cover for business planning, family planning, etc. So those are the order of priorities to me.
Quick question I have for you, Josh, if you don't mind, before you get on to the next one. You hear a lot of people talk, or a lot of insurance people talk about the return of premium riders on a lot of the DI policies or CI policies. Maybe you can touch on them, whether they make sense, it's a good idea, is it overkill?
I like them. I haven't done the analysis in a number of years because it all comes down to the rate of return on your return of premium. It was around 7 to 8% 5 or 6 years ago. May have come down with claims and things like that. But I think what you have to look at is how much you're getting back in the amount of time and how much more could your money be doing for you if you didn't do the return of premium.
So I'll tell you, Josh, I purchased a return of premium from you guys about 27 years ago when I first started. And I'll tell you, the return of premium over my entire lifetime, I'll end up paying the insurance company basically 1 year of what I would have gotten back over an entire lifetime. So for 1 year of income, which probably you know, I think we got a $60,000, $70,000, whatever it is, for $60,000, $70,000 over an entire lifetime, I'm guaranteed to get a payout should I become disabled until retirement. Uh, so I think it is absolutely a no-brainer, and I think that is a tax-deductible expense as well, if I'm not mistaken. No? Oh, that's why it's
Unfortunately,
Not
disability.
disability.
Yeah, not
not
disability.
disability.
Yeah,
Okay.
The
disability.
only insurance that's tax deductible is if you get it for business loan purposes and you need it. So it's another reason to have, that's why the banks want life insurance, but it's deductible as well when you get lending for a practice.
So, and again, I think this is a good point here as well. As dentists, we sometimes think we can do everything, and we're pretty good at doing everything, but it's definitely good to have good advisors and specialists in the room. That
Well,
can guide you correctly.
as I said earlier, there's a lot of people do a lot of things, right? I
Yeah.
mean, we're in a situation where you're within colleagues, you're talking, oh yeah, I do this, I do that. My accountant does this, my accountant does that. And that's fine. As I tell people, as long as you can sleep at night and you feel comfortable, right? But sooner or later, or one day, you may get a knock on the door, or a call, or a letter from CRA, and you have to justify certain things. Then you deal
For
with it
sure.
at that time.
For sure. When you're starting off, money is tight, you know, and
It
you're,
is.
you're always looking at ways to kind of save. And again, we've gone through this as well. We went through all the right channels, redid everything down the road and did it properly, right?
Yep.
Uh, there is a big difference between do it yourself and having somebody properly do it. And you learn a lot in that process too. So
As I tell some people, I can pull out my tooth as well too, but I care not to.
yeah, 100%, 100%.
Let's move on, Jake. Yeah.
All right.
I think
So
we talked
we
about
talked
this
about
one.
this already. Yeah.
Yeah. Yeah.
So
Yeah.
that's
Yeah.
that's pretty good.
This is a I mean, I guess just a quick little numerical example, right, Josh? It's just
Yeah.
Josh's point earlier. Yeah.
Yeah.
Good.
Perfect. So I'm an associate now and I'm ready to buy a practice, right? Have some savings. Unfortunately, the way the multiples are going these days, it is quite costly to acquire a practice. In fact, it's quite expensive to build a practice these days with all the equipment costs and leasehold improvements that need to be done as well. Any tips or ideas, or do you guys assist in this? And if so, anything that you can share with our audience on this?
Sure, Josh, want to get started?
Yeah, so I think the biggest thing is having an accountant or an advisor that can actually look at this and make sure that you're not buying a lemon, first of all. You got to make sure the cash flow works, that you can pay the loan, you can pay yourself. If the dentist that's selling, if you're buying existing, wants to stay on, you can pay them as well. We have our own internal templates we use. And based on that, and plus our experience, we look at almost every practice purchase opportunity for clients that are under our umbrella. And we guide them. I like to guide them on a pros, cons, and opportunities. Because there are a lot of opportunities in practices that are being sold, because a lot of these practice owners are towards the end of their career, so they're not looking to grow like crazy. So there are opportunities there. But there are lots of things we look at. The lease is a big one with the demo clause. I know the banks are being a little bit more lenient on demo clauses, but it's still pretty tight. That's a big one I look at. And then longevity of staff and planning for staff as well. These are a lot of things we look at beyond the financial numbers. But when you're ready, if you have some savings, that helps corporately. That helps a lot, especially for the first couple of years of cash flow. Not necessarily lending, but just having cash on hand to pay yourself or make ends meet until you build it up a bit.
I'll throw a question at you, John. I'm a young associate. I've been associating for 2-3 years. Sorry, Neil, I'm jumping in here, but now I'm getting the itch that I want to either start or buy a practice. Do you lean one way of starting a practice from scratch versus, looking at all the appraisals that are out there and the brokers and buying existing cash flow?
So I also do in-depth business plans for starting from scratch. It is quite costly. I lean towards buying a practice if you can find the right one. Now that's easier said than done, especially with the amount of buyers versus sellers and et cetera. But you have patience, you have cash flow, you have staff. You don't have to do everything from scratch. Starting a practice now, I sometimes run the analysis a little bit. before COVID and after COVID, it's almost like it's doubled to have a 3-op practice startup. Like it's kind of crazy the cost now. So I
Maybe
lean towards buying
ask our moderator what he did.
I'll tell you, you know, you're definitely, every dentist has to look in the mirror. You could be a great dentist, and that's perfectly fine. You have to have a great personality and a great way of communicating and a great way of building a business. And if you can do this with your patients, you can definitely build a practice from scratch, and you will be very successful at it. It is hard. You are going to have to, work extremely hard as opposed to walking into a practice that already has cash flow. But the reward is much greater when you build something yourself. The other thing I think right now, Josh, and correct me if I'm wrong, is the banks are giving you pretty much 100% financing on these things. So money is available. You really don't need any of your own. Always definitely good to have a float to keep things running for about 3 to 6 months. But other than that, yes, it is tougher to start from scratch. But if you got the personality and the drive to do it, God bless you. You will be successful.
Yeah, it is funny, Neil. You just said the banks are willing to lend, and they are. They have historically been, and it's probably one of the only professions where you come out of school, not have worked a day in your life, but because you have your DDS, and you said I need $1 million to open a practice with very little collateral, they tend to lend you the $1 million. I mean, if you're a mucho burrito owner and you want to start one from scratch, you have to give your left arm and your child, your first child born, to in order to qualify.
No, for sure. And uh, it's yeah, it's incredible. The only one that's actually above us probably are the veterinarians.
Right.
They have money pouring before they even graduate.
Yeah, there's less than them though. So
We charge $200 to take out a tooth. If you got a dog, that's $2,000.
People
So
love their animals.
they love their animals.
All right, let's move on there, Jake, please.
Yeah, I'm just going to jump in with a quick poll here for everybody. See if everyone's been keeping up and paying attention. When is the right time to incorporate? You see that on your screen.
I like D.
Yeah, I mean, at least win the cup.
Perfect. Here, let's share the results with everyone. Fantastic.
that's good responses.
Yeah.
All right. So mid-career. So now we're in a stage where we got our practice. We are working away. We're building an empire. We're putting out bright, shiny teeth out there. Is the structure still optimal? Has there been any changes post-COVID? Is there things that we should be doing different? What do you guys see that has changed dramatically and that we should be careful of in the future?
Jake, just pull the next slide up if you don't mind, please. So we sort of tried to categorize it in a few different areas. It's not the be all and end all of all the things. And again, we're open for questions at the end of the webinar. So please, I see a couple of ones that have been coming up through the chat, and we'll definitely address those at the end. But these are some of the common ones that we hear from a lot of our mid-tier, we'll call them, or new practice owners getting into, as Neil says, producing shiny teeth and running a business. I'll choose one there, Josh. Maybe you can take a look at some of the other ones.
Sure.
But the one I hear a lot is hygienist remuneration. We've again into a situation, especially post-COVID, Neil, as you have alluded to, where the costs of staff, hygienists especially, but not necessarily just hygienists, whether you have dental assistants, just staff in general. I think post-COVID, people's mindsets have changed. We're seeing it ourselves, even in our own offices. And I think keeping staff and good staff is an expensive proposition. So people want to come up with unique ways on how to pay their hygienists. We have many clients that ask us, should a hygienist be paid on salary or can I pay them as subcontract? And this is a very, very hot topic and one that could come to roost from a CRA perspective. I've been down this situation many a times with many a clients and with CRA. And it usually comes into play not when everyone loves each other and when everything works properly. It comes into play when you have a disgruntled employee. That all of a sudden that employee leaves, and then the literal S hits the fan, because now you have an individual that may contact CRA or may contact an employment office and say, well, I've been getting paid, from my dentist this way, and now I no longer have a job. I want to collect EI. And they're going to say, well, where's your record of employment? Well, I don't have a record of employment. Well, how are you paid? I don't know. I just got a check every month. I assumed things were taken care of. So you got to be mindful. The CRA definitely has a number of factors that they look at in determining whether an individual is employed or self-employed. Things like control. Do you have the control of your schedule? Can you come and go as you please as a hygienist? Is there financial risk if the chair is empty and the schedule is empty? Are you sitting around, cleaning instruments? Are you getting paid your full price? Is there risk on your part? Do you own your own equipment? These are all factors as to whether an individual is self-employed. If you answer no to many of those questions, guess what? You're an employee and you need to pay the individual as an employee with deductions. The only way I see potentially around this, hygienists have their own college. They have the ability to incorporate as well too. So if they set up a corporation and one corporation pays another corporation, then now you pass on the risk to that hygienist corporation and they can pay themselves as they see fit, as we discussed earlier, whether it's with dividends or with salaries. But if you're strictly just cutting them a check and they're not incorporated, you run a risk.
Okay, so I think that is a major take home message today for a lot of dentists out there, that if you, and again, no guarantee, but at least you're reducing the risk if your hygienist is incorporated versus being a sole proprietor or an individual. If they're incorporated, you're mitigating a certain level of risk. So keep that in mind when you guys are paying a hygienist. And then one other thing that may potentially help with that is if they're taking a percentage, because now their salary fluctuates as well with what they're doing in the office. So they do have some control over their income.
Yeah, 100%. Like I said, it's a common question we hear. Unfortunately, a lot of horror stories. I mean, I've got a number of stories that dealing with an individual now that had a 30-year employee that, he catered to this individual, paid him a little bit of salary, paid him a little bit self-employed because they were a good individual, they were a good worker. But, over the last number of years, the relationship soured, and now he's in a situation where there's a big severance payout that's required because this individual is becoming a disaster to the practice and to all the other staff. And it's hundreds of thousands of dollars in severance payments. So even if you have a contract, always be careful, right? Because these things can bite you.
Yeah, and once in a while, we're all getting temporary hygienists or assistants and so on and so forth. And those definitely, I think you don't have to set up as a full employee unless that person is coming in regularly and very often. Then I think they will be deemed an employee at a certain point, right?
Yeah. I mean, one-offs here and there, you know what? I mean, technically, CRA will say you need to pay them on payroll, but it just becomes unrealistic to set them up to pay them for one Saturday, right? I mean, but I don't think it's a big thing. Josh, you want to take a look at one of the other ones? Maybe you have.
Yeah, I thought I'd talk about investing corporately, or am I saving in the right places? I think that can be a hot topic, especially as you get to a point where maybe you're well along in your practice career. The debt in the practice maybe is almost paid off or paid off. You have a mortgage, but you're doing good at it. I can't emphasize this enough. Your corporation is the best place to invest first and foremost. Now, there are caveats to that because there's a new passive income rule that was released, I don't know, 8 or 10 years ago, or it's not new, I guess, but you have to be mindful that you don't increase your corporate tax on your operating income. But there are lots of investment strategies that can tailor to this. So I like investing in the corporation first. Now, there's different structures you can do as well when you get to that point. You can open up a holding company, move funds over there and invest. And there's pros and cons to that as well. RSPs are always a no-brainer. You can always bonus out money with no tax withheld and build up your personal retirement savings outside your corp. TFSAs, those are good if you're not at a super high tax bracket and you are taking out money and you have a little bit excess personally. But if you are at a high tax bracket and you have corporate savings, it's probably better to invest corporately. Insurance is a hot topic. A lot of people are doing insurance inside their corporations. A lot of these permanent policies that have an investment component. They're great. They're a tool like anything else. Timing is important with these because I think they get sold a lot, and a lot of the people don't talk about the fact that it's not as easy to get your money out of these insurance policies as you may think. You just have to be well aware of the pros and cons. So sorry.
I definitely want you guys to touch on this income splitting thing. So can I split income with my spouse? Can I split income with my kids? I know I wanted to split income with my parents. My dad said, listen, I don't want your money because I'm going to lose my pension. And I want my free money from the government that I've paid my whole life. And I explained to him time and time again, it's going to be more beneficial for me to pay you and keep that money at home. But no, he wanted his old age pension and did not want to lose it. So I had to bite the bullet on that one. But can you split income? Is there benefits to it? And what are some drawbacks to it? I think that's the big one for us too.
Yeah, good question, Bill. I mean, I think you make a funny point there on the old age security. It's incredible the stories we get from people on old age security and wanting to get their old age security, and if it gets taken away even $1, the pushback that we get. We do, between Josh and I, we do a lot of planning to make sure people don't lose their old age security or there's no clawback. We can touch on that a little bit later, but it's just hilarious. Because they feel, like I said, they've been in this country for 40 plus years, if not more, contributing to the overall good with HST and all the other taxes that they deserve every penny that they can get. But from a splitting of income, and again, number one question, and we talked back about salaries and dividends. Yes, splitting of income is legally possible. It's not something that's frowned upon from CRA. I think the key is, and as I tell people all the time, the individual who performs the task, whether it's the dentist, whether it's your spouse, whether it's your child, that they're performing a task, that they're getting paid appropriately for the level of work that they're performing. If you are paying a spouse or an individual for absolutely nothing, and they are paying a salary, then you potentially run a risk. So if your spouse is working or your child is working, make sure they document what they do, have a contract in place, document their hours that they spend, and pay them an appropriate wage. If you think you're going to pay your 13-year-old child $100,000 for filing your dental records, I think that's a little aggressive, right? But if you pay them, an hourly wage, whether it's, minimum wage or $15 to $20 an hour for 20 hours a week or whatever works out to be after school or on the weekends, then that's a reasonable thing to do. Paying an individual a dividend, as long as they're a shareholder of your corporation, the TOSI rules that's mentioned there on the slide, there are rules that came into place, maybe like Josh said, probably close to 10 years ago, where individuals that were shareholders had no restrictions on how much and when dividends could be paid. I had the fortune to have a corporation set up when my kids were going to university, and I always have a funny story that my kids around their classmates, and they talk about OSAP, and they say, "Oh, have you got any OSAP money this year?" And my girls would sheepishly say, "Well, no, I get a dividend check." So they didn't want to say, but those days are now unfortunately gone because our
Okay.
government decided to implement these tax on split income rules, and it comes with certain restrictions. You have to be active in the corporation. You have to be working for the corporation. You have to put in a certain amount of hours, or you have to put in equity into the practice. So if you have a spouse and you've both borrowed money or have gone to the banks and put yourselves on as personal guarantees, then that allows you to pay out a little bit of a dividend to income.
So we won't talk about this, but so I guess in the event of a marriage failure, not only are they going to take half your practice, but then you got to fire them and you got some employment
Severance.
issues too, right? So it could become a very complicated situation.
You know what? Like again, it's a very, very hot topic, something that's done often. We see it all the time, right? But again, just make things are documented and they dollars are spent and paid for appropriate level of work performed.
Okay, I think we've talked about this.
Yeah, I think we've
So
yeah.
mid-career, what if I get sick or burn out? What are some contingency plans here? Or I guess even if you die, I guess, right?
Well, I mean, let's hope you burn out and you don't die. But maybe Neil, we can spin this one back to you a little bit, right? I mean, you're probably seeing a little bit more and more of some of your colleagues, and you've been practicing for a number of years, and this burnout concept. What do you think?
Yeah, it's real. You know, the problem is it's the practice of dentistry is not the issue. It's the management of it. You know, between staff, between compliance, between regulations, between all the forms and everything else you need to fill out, employment health tax, you can get payroll companies, you can get this and you can get that, but at the end of the day, it still all falls under your lap. It is becoming very onerous to run practice, and staffing is the biggest problem. You are a psychologist, you're putting out fires every day. Patient expectations have become unrealistic, and especially with the Canadian Dental Plan, everybody has a level of entitlement that you're dealing with. Why isn't this covered? Why am I paying a difference? It is becoming extremely difficult. We are now working for less money, and we are working twice as hard for that money. It's tiresome and it's exhausting. So it is a real thing, and hence you see a lot of dentists out there that are exiting, and which is fine. My whole thing about exit is if you're going to exit, goodbye. You leave the practice. If you're going to stick around and work for somebody else and be a partner with somebody else, then you might as well just continue doing what you're doing. I think you're still going to be ahead of the game. But if you've decided one day in the morning that, you know what, I'm done, I'm gonna move to Mexico and drink margaritas for the next 10 years, then by all means, sell it and get rid of it. So that's my take on it. Finding good team members is tough. We're dealing with Generation Z, which have totally different expectations than what we do. They're interviewing you when you bring them in. So it is tough now. And a lot of people are opting not to become owners for that reason.
Like you said, I think most dentists are great clinicians. It's the business aspect of running a practice that puts a lot of pressure. And, sometimes you have some good, we'll call it an office manager that can help alleviate some of that, but those are hard to find, and it's a difficult task. I think, I've always thought, is there a service? Is there something that someone can create? Maybe this is a business opportunity where, you package, HR, you package office management, you package, legal, everything under one umbrella, and then you go to the dentist and you say, hey, for X percentage, a certain dollar amount, I will take this all off your plate. Is that something that it would interest you, or people think it's too much, or it's one of those things that you're paying and you don't know exactly what you're getting?
Well, listen, after 27 plus years of doing this, I have one office. I don't have multiple offices. I don't even know how guys handle multiple offices. Good for them. They're definitely better business people than I am, because handling one office is definitely stressful enough. We are a large office, but dealing with 50 employees, and multiple associates and specialists, and hygienists, it's quite the task.
Good. Josh, want to add anything before we move on?
You covered most of everything. I just think if you're starting to feel burnout, come up with a plan to outsource the things that you do that someone else could do, or push it off, because you're just one person. You can't do everything all the time. And it doesn't have to be everything all at once. Maybe once a year you sit down and be like, okay, I do this, but I can have someone else do it and it will be done just fine. And then you can slowly free up time for yourself, because that's your biggest resource, is time. So
maybe somebody will start selling insurance for burnout.
Maybe.
Well, critical illness is there, but
Yeah. Okay, so after working so many years, and getting tired, what's the exit plan? What's my practice worth? Do you guys do appraisals? Is it a good time to sell? Is it, what's your thoughts on those things?
Yeah, Jake, do we have the next poll, or was that after this question?
That was right after this slide here.
Okay.
Yeah.
Okay. Yeah. All right, Josh, you want to take a stat?
Yeah. So your practice is most likely sellable. I mean, it comes down to how much profit there is after you pay yourselves and you pay your expenses and things like that. And that's going to determine your price for the most part. There's things that could be added back and things like that. But buyers, like it says there, want clean financials. They want a situation they're coming into where they have stable employees and associates. If you don't own the building, they want to see a lease that's in place for at least 10 years, and predictable income. That speaks back to the profit. So most likely your practice is sellable, but we take a deep dive look for all of our clients on a yearly basis, and we make sure they realize that it is, and if it is increasing over time as well. And if it's not, then what areas should they work at to make it more sellable?
I think a lot of the times as well too, and when people are looking at the valuations, there's a number of evaluators and brokers out there that produce the valuations, and you hear a common term. You hear the term EBITDA. Some people feel it's the be all and end all. It's the determining factor as to the profitability, as Josh alluded to earlier, of a dental practice. What EBITDA stands for is earnings before income taxes, depreciation and amortization, which is pretty much your cash flow of your practice. Because your practice, in order to sell, needs to have a good, reasonable cash flow. And that cash flow should factor all expenses to running a practice, whether it's your rent, whether it's your staff, your sundries, and most importantly, the cost of paying a dentist to do the work. I think a lot of times we see valuations that don't necessarily show the value of what a dentist is to be paid to do this work. Because if you look at the DSO model, whether it's the Dental Corps or the 123s, they always factor in the cost of running or paying an associate, because they can't operate a dental practice without paying someone. When you're working in the practice, you are paying yourself, or you're paying your spouse, or you're taking money out in different formats. But in order to come up with a proper EBITDA cash flow number, that is your key, because practices are sold as a multiple of that number. We won't get it too much in terms of the ranges and stuff, but historically in the past, practices were sold based on a percentage of your top line revenue, whether it was 1 times or 75% or 2 times. That is a helpful tool, but it's not the only tool. It's based on your profitability and how well you run and operate your practice.
And I guess how well it will run without you.
Another good point. I saw a little question or a little chat that popped up earlier is what kind of attrition can you expect if there's going to be a changeover? And you know what? It's behooving to the individual seller to stay on and help with the transition so that the practice does ultimately keep the cash flow and have a good transition period. You know, is it 10%, 5%? I've seen that range anywhere from some 5 to 10% transition or attrition, sorry, when practices are sold, especially if dentists don't stay on to help with a smooth handoff.
Very good.
Jake, you want to bring up
interesting point, yeah.
the next poll?
Yeah, let's do it here. Awesome. Should I invest corporately or pay down debts, either personal or business? A few answers come in here. Yeah, as we suggested, it's never really black or white. Usually the answer lies in the gray zone.
Excellent. Let's move on to our last component, which is when a lot of our dentists are looking to start exiting. We are at the 1 hour mark, and we probably have another 15 or so minutes, I would imagine, before we get into questions. So hopefully, if you have to leave, we thank you. If not, we'll carry on.
So once you've decided that you want to exit, what is that exit strategy? What are the tax implications of that exit strategy of selling your practice? Does it make sense to stay on as an associate and earn an associate draw? Tell me a little bit about that. What is the ideal situation you kind of want to be in?
Sure. Josh, you want to interject?
Yeah, I thought I'd tell a story because, I'm going through it recently with a dentist that sold their practice and is associating, and it was the right time for them. And been working with us for a long time, I think 10 plus years. And I started the exit planning right away, at least from a structural standpoint. And so that all of the dollars that they saved corporately didn't affect the sale, got to use the lifetime capital gains exemption. And I'm glad I did, because this dentist was originally supposed to sell 3 years from now, but they hit their target as far as the planning and how much they needed for retirement, actually exceeded it, and was just done. They hit the burnout. It speaks back to that burnout, and was done and wanted to step away. Gonna associate a couple of years, just was done with the management and etc. It was so easy for this dentist to sell and only worry about the sale instead of the accounting and structural standpoint, that it was as turnkey as possible, realized as much tax savings as possible, and is now probably the happiest person I talk to on a weekly basis. So that, to me, the planning is nonstop for your exit, whether it's 5 years away, 10 years away, 15 years away. Once your practice loan is almost paid off, you got to start planning. I know we say 5 to 7 years here, but the sooner you start, the easier it is when you are ready to move on. And it's not like a set time in stone, but if you're ready tomorrow, then you should have started planning a while ago.
Because I
You
think the
mentioned
misconception.
the capital gains exemption. Now you can use both yours and your spouse's towards that, I'm assuming, right?
Yep.
Yep.
Well, I guess it depends, Neil. Josh, Jake, you might just want to put the full slide on there for me, please. The capital gains exemption, or the lifetime capital gains exemption, is the biggest tax planning tool we have currently as individuals. It hasn't changed. Will it change in the future? We don't know. There's many indications during budget time whether it's going to be taken away for business owners. One of the benefits for last budget is they actually increased the capital gains exemption to 1.25 million. It was at $1 million previously. It was even at 750 a number of years ago before that. So actually our government actually done something advantageous for many practice owners, where you can ultimately sell your shares of your practice and qualify for the capital gains exemption up to 1.25 million. And that's a tax savings of about $300,000. So it is significant. Yes, if structured properly, if your spouse or even your adult children or even your parents, if they are shareholders, they too can benefit from the capital gains exemption. The structure of these things is an important tax planning item, and it needs to be looked at, not simply the year before and say, oh, I'm the only shareholder. I'd like to have my wife, my parents, and my children utilize the capital gains exemption. Can I do that? No. Only if it's structured properly, done so well in advance, can you benefit from multiple shareholders and multiple capital gains exemption. The taxation part of the large capital gains exemption is excellent. However, you got to be mindful there's legal issues when it comes time to having individuals as shareholders, whether it's your children or your parents. Potential issues if your parents pass away when they're shareholders. We can talk a little bit about that towards the end when we talk about some estate planning. But all I tell my clients is, let's structure things properly. Let's make sure we understand what your objective is down the road for retirement. And I think the next slide, Josh talks, or Jake speaks a little bit to the types of methods on selling a dental practice and whether the practice is sold as an asset sale or a share sale. It's a common term that many of us hear, and a share sale is what a seller always wants to sell because of the previous slide, they qualify for the capital gains exemption. On an asset sale, it isn't as tax advantageous. However, it's not the be all and end all. If you've already utilized your capital gains exemption because you were fortunate enough to have 2 or 3 practices and you sold one practice a few years ago and you have a couple others, it doesn't mean that you have to sell shares. You can sell assets. There are ways to structure it so that you bleed out money from your corporation over the number of years in retirement. So it isn't disastrous if you're forced to sell assets. In fact, asset sales can actually fetch you probably a little bit more from a sale purchase price because a buyer is willing to buy assets because it's more tax advantageous for them. So again, it's not the be all and end all, but obviously the share sale gets you the biggest bang for your buck immediately with personal tax dollars in your pocket.
Very good. Very good. So when you're ready for your exit, what do you guys see as the best time? And then once, let's say I am to sell, and where does that money goes into my corporation? If I did a share sale, I'm assuming I'm selling that corporation. Do I open up another corporation where that money goes into? And then do we draw from that corporation? What are the tax implications of that? I think the biggest thing I've learned in this field is that, you know what, you can never escape taxes. You can just defer them and kick them down the road as long as possible and use the government's money for free or somewhat free in the interim. But at the end of the day, they're knocking on your door either before you die or after you die.
Death and taxes, Neil, death and taxes, right? You're definitely never going to avoid. Defer is always a good D. It's always something that you want to be able to deduct, and defer is also another good D. But sooner or later you will pay. Then Josh, you want to step in and maybe address a couple of the points on the screen?
Yeah, best time to sell. I think the biggest thing is when you're ready. I mean, that's the biggest one. I mean, if you truly want to stop managing a business, then you got to take a hard look. And it doesn't mean you have to uncouple from doing dentistry. It's just that's the main one I see from people that are looking to sell or dentists looking to sell. How do I extract corporate funds? That can be quite complicated. That's why it's great to have a team that integrates everything together, because most dentists have different buckets of assets or retirement assets, RSPs, TFSAs, corporate assets, life insurance, et cetera, et cetera. And then you throw a spouse in there and you can split income, and some dentists have multiple corporations. So we take a look and we take from tax advantageous sources with a mind on OAS. I thought I'd throw OAS in there, because that's a big sticking point. You don't want that clawed back. And we design retirement sources of income so you pay as little tax as possible and you defer as much as possible and you still live the life you want to live. We're very mindful of double taxation. We don't want that, but we also want to take advantage of the mechanisms inside of a corporation to get tax-free money out as well in retirement.
So I'm assuming at that point, after you've sold and you got the money in the corporation, then you're pulling out dividends.
Yeah, if you do an asset sale, then you're going to have a dividend sprinkling strategy throughout your retirement. You don't have to. I like to melt down RSPs first, because it's typically relatively same taxable income, but RSPs are taxed higher on an estate level than the corporation. Not hugely, but everything counts.
Just to clarify, Neil, just to make sure that people are aware, so because you sort of said something that might be a little confusing.
Sure.
If you sell your shares of your corporation, you mentioned earlier, your corporation no longer exists, and now you've received, whether it's $1, $2, $3, $4 million of money personally. They're now in your personal bank account. You will pay personal taxes, and you will qualify for a personal capital gains exemption. A corporation does not have a capital gains exemption. So if you sell the assets, you pay some tax at the corporate level, maybe at max around 25%. Money stay inside the corporation. And to Josh's point, it's then bled out over a period of time to help with your retirement need. There is a portion that can come out of the corporation tax-free, something called through a capital dividend account. It's the non-taxable component of a capital gain. But it's something that you got to be mindful that if you sell shares, you will receive the dollars personally. When we talk about, you'll hear a term called purification. If people have built up assets or build up investments inside their dental professional corporation and want to sell their practice, they have to go through a process to ultimately remove those assets from the corporation as tax effectively as possible. You don't want to remove them out personally into your hands because you will pay the top bracket. You could do that. It can be say, you know what, I don't care, I'm going to pay tax sooner or later and I'll take the money out. Or we come up with a strategy where we create another corporation and ultimately try through a reorganization to move those assets over to the other corporation. Now you're in control of those investments in that corporation. And then with the help of your advisor, you figure out a strategy to pull out that money from that corporation. That's in addition to receiving your proceeds from the sale of your practice. So you've been fortunate enough to have been in practice for a number of years. You've paid off all your debts. You started accumulating assets within your corporation. Time to start thinking about an exit a number of years before. You then start the purification process and moving some of those dollars over. So it is a complicated process, as Josh alluded to earlier. However, when structured properly, and I know Josh, in your client's particular situation, they were in that situation and the purification process and the reorganization worked quite well. And now they have several buckets, as Josh alluded to draw on in retirement.
Good. All right. So let's now look at the ultimate and the dying of the dentist. All right. Whether that's intentional or unintentional, what happens at that point? Now, I know, and again, I'm not speaking on behalf of the college, after the death of a dentist, there is some time frame that's given. It's not set in stone to allow the the assets and everything to be uh, disposed of in terms of a financial perspective. The records and charts and everything else of a patient has to be transferred to the custody of another dentist or healthcare provider. And so that has to be done in a specific period of time. So how do we prepare for that? What do I tell my spouse or my kids to do when Neil's gone? Or do I do anything before that point?
Yeah, no, good question. Josh, I'll let you take a crack.
It's a hard one, right? Because you don't plan on dying. But if it's a concern of yours, or you just want to be super protective or proactive, then you obviously have colleagues you're close to, and you can make kind of a verbal deal that they'll step in and help the spouse make sure it runs at least up to par for the short term. But I think the spouse should look to sell as soon as possible, like before it loses any value or a significant value. That's
Yes. So that's the first
unfortunately
thing
the answer.
I've told Sona, is that in the event of death, you literally have 30 days to sell the practice, because after that, the value starts diminishing
Yeah.
exponentially.
Well,
Yeah.
the vultures start circling.
Yeah.
Yeah, that's the unfortunate part, right? And
Yeah.
and planning on things, like I said, the double taxation on death. I mean, dying as a practice owner, as a single practice owner, when you have a spouse, your practice, as I said, could be sold. The shares or the ownership, there's something called a spousal rollover. Your spouse can receive the shares of your corporation, and defer potentially a taxation. However, again, the college may step in and force a sale. Um, However, an individual does not have a spouse and they have passed away owning a practice. We're not going to get into too much onto the taxation of individuals at death, but let's put it this way. When an individual passes and they don't have a spouse as a remaining individual to pass on their investments or their assets to, CRA deems all those assets to be deemed disposed of and sold at death. So if the fair market value of your practice is $2 million at death, and you're going to potentially look to sell it, and it might be worth 1.5 to 2 million, your estate will have a tax liability potentially of up to 25%. You can utilize your capital gains exemption at the time of death, so that's still available to you. Again, if you qualify for the capital gains exemptions, and there are tests and rules in order to qualify for the capital gains exemption. So keeping a clean, purified company as often as possible makes future planning, especially post-mortem planning, a little easier.
Interesting, Steve. It never crossed my mind that my spouse would die prior to me. This is the first time it's kind of sunk in when you just said that I've always under the assumption that I would probably go first, or she would kill me. But no, jokes aside, that's an interesting, what?
Yeah.
I never thought about that.
Yeah. So it goes back to estate planning and wills. These are very important things that we definitely take a look at, and Josh can allude to it. And even insurance, we talk about whether insurance is oversold sometimes, but it does serve a purpose. And unless you want CRA to be your business partner, which we sort of spoke to earlier, insurance helps mitigate that relationship with CRA, because there will be a buddy there, or your life insurance proceeds, to help deflect some of those taxes at death.
I'm doing more estate planning now than ever. The amount of meetings I have just surrounding estate planning discussions is incredible. And people think it is very simple. It is not. There are layers to it. Whether you don't have a big family, or you have a big family, or you have a lot of assets, or you don't, it is crucial that you have an advisor that's well versed in it and can know the nuances. And luckily with our office, we bring lawyers in-house and we have meetings together so that everything is integrated. That's really, really key. And then you review it every couple of years because things change very, very quickly in life, especially people you name on wills and powers of attorney can have a falling out, or they get too old, or you don't think they can do it anymore, or etc. Life changes drastically very quickly. So don't take estate planning lightly. Don't ignore it. It's not the funnest conversation to have, but the peace of mind you get when you have a good plan in place, it's really good to have. So
No, it's important, Josh. And I'll add one other thing. I mean, as business owners, your situations are complex, and you get to a point when, unfortunately, the day comes and your number is called, and you may have a will that was done a number of years ago, and if you named your brother or your sister as the trustee, or maybe your children, burdening that individual, I'll call it a burden, because trying to settle an estate when it could potentially be worth 10, 5, 20 million dollars, and the individual does not have the expertise. As the trustee, it is their obligation to make sure that the beneficiaries, as per the will, are looked after. And now when you're dealing with multiple corporations, multiple sources of investment assets, it is an onerous task. And there are many people that consider corporate trustees. I'm not pushing for a corporate trustee, but it is out there as a potential available to individuals. Maybe something you haven't heard of, but instead of naming an individual like a spouse or your siblings or your kids, you can name an entity, a corporation. That's their job, and they do take a percentage of your assets, but you know it'll be taken care of appropriately.
Yeah, no, I think, you guys do a fantastic job of that as well, because like dentists, do-it-yourselfers, we had our own wills, pretty much off the internet. And then sitting down with these estate planners and stuff with you guys, never had any idea of a primary will, a secondary will for your corporation that's dated 1 minute after your primary will, to dispose of those assets and protect those from certain taxes and so on and so forth. So there, penny wise, pound foolish. Sometimes it does make sense to bring in some proper people to do the work for sure.
Especially if you care for the next generation, right? I mean, the wealth transfer in our industry, or in the next 10 to 20 years, between the baby boomers that are moving assets over to the next generations, is a significant dollar amount. And if you want to make sure that you're keeping as much as you can within the family structure, which I think all of us want to do, then it's important that you structure your affairs accordingly. Last question, I think.
I can talk to this one because I get asked this question a lot, and sometimes I ask it a lot. Once you're taken care of, I usually give the airplane analogy. When they're given the safety briefing and the air mask comes down, you always put it on yourself first, then you take care of your kids. That's the same thing with financial planning. Make sure your retirement's taken care of before you start considering gifting to the kids. However, planning on leaving a lot of inheritance to kids is fantastic. But if you get to a point where you have more than enough, which hopefully everyone does, then maybe you want to gift sooner rather than later, not just a financial decision, because gifting sooner than later can reduce your tax burden now and into the future. But you also get to see the joy in your kids' face when you help them out, when maybe they have more struggling years than when they've made it, so to speak. So there's lots of factors to that, but it is a very important discussion to have. And I usually have 2 or 3 meetings on it, because it's hard to wrap your mind around, because everyone wants to hold on to everything they have and they want to make sure they have enough. But a good advisor will tell you that you have enough and show you that you have enough. So gifting can be quite good early on in retirement, if that's what you want to do.
Josh, I think you made a good point with the oxygen mask that dropped from the plane. I think in that same breath, I think as dentists, you guys have worked hard. Spend your money, enjoy your money, spend it on yourself first. Yes, sometimes you think, what, if I don't blow it, my kids are going to blow it on their girlfriends, boyfriends, and everybody else. And you know, sometimes we call our kids professional waiters. They're waiting for us to die. You know, enjoy, you've worked hard, enjoy it. Don't worry about the taxes. And, you know, I know when we sit down with Steve and Josh and everybody else, you know what? Spend it on yourself, right? It's not always about, you know, the future either, right? The future is there, and you know, as concerned parents and everything else, sometimes we're too concerned. So, you know, enjoy it, you know, the fruits of your labor and everything else. I think that's a key take home.
Yeah. You know, we get into the topic a lot when we're dealing with taxes and we're dealing with futures and we're dealing with savings and stuff, but money is very emotional, right? You know, we've all dealt with tragedy one way or the other, whether it's parents or friends, you know, and always having the same story. They died too young, and you know, it's not going to be me, or I'm going to enjoy my life. And then the next day you wake up, you go to work, and you got the same problems that you had the day before, and you forget about what you just witnessed at the wake or funeral that you were just at. You know, so as Neil says, I tell people you work hard, you enjoy it. Obviously, be mindful because you're not want to put yourself in a horrible debt situation where you're going to cost your family the future as well too. But if organized properly, you guys are in a great profession. I think you guys have the ability to make some pretty good money. You have the ability to save the money. You have the ability to spend it. Just make sure it's structured properly and enjoy. Jake, one last poll question, then we can get into some questions.
That is the key. You know, dentistry, we are all blessed to be in this profession. It's a great profession. It's great to help patients and spend time with them and work on them. The moral of the story is let's make sure that Carney and Company doesn't take a lot of our hard-earned income.
Excellent. All right.
Yeah, we got one final poll question on the screen here. When should I start thinking of selling my practice?
Those damn Leafs come up way too often.
Perfect. Forward thinkers. That's great.
Absolutely.
Good. We were looking at probably a hard stop in 90. You got a few minutes if you guys want to answer some questions, and maybe that will lead to some other discussion.
Sure.
We're good on time. Those that wish to depart, we wish them all a good night.
Yeah.
And those that want to kind of stick on and ask and hear the answers.
Jake, are there any particular ones that stand out, or
We
try to
do have
answer?
one. We do have one in the Q&A section here.
Okay.
Is it possible to have a family trust own shares of a dental practice? Can this help magnify LCGE?
The college, unfortunately, the way it's worded, does not allow in Ontario especially, I think that some of the provinces it might be a little different, but in Ontario, currently a individual dentist, his spouse, his parents, or his children can be shareholders of a dental professional corporation. It cannot be a family trust.
Do you guys help with buying a practice? And if yes, how?
I could take this one, Steve. So
Sure.
yeah, we absolutely help with buying a practice. So we can help from the infancy stage of when you're looking for a practice, you can pass us appraisals and we'll do a pros, cons, opportunities, guide you along the process of getting a lender, what that looks like, getting a lawyer, what that looks like. And we try to be in the middle with you, quarterbacking everything, because it can be quite overwhelming because it's your first time doing it. Well, maybe, but it's our many times doing it. So that's how we help. We guide you. And if you need expertise in it, then we dive deeper and we'll even do projections for you as well if you're serious about the practice.
Perfect.
I think it definitely helps to have a team behind you. You know, I'm privy to my numbers. I know what to kind of expect. But like some of the questions that came up, you know what is the attrition rate, you know, when somebody new comes in? These are definitely great questions. And ones that a group like TMFD, who have hundreds of clients, have that kind of knowledge and information that they can pull pull together and guide us on. So from that perspective, like I said, do not go at it alone. Get a good team together for it.
And perhaps this question relates to that as well. This person says, having recently attended the PDC, there are several financial planners and wealth managers. How should a dentist choose a financial planner and wealth manager? Any comments on using CDSPI?
Josh, I'll let you take this one.
Yeah, I think so. There's lots of articles you can look up on like what's the right questions to ask an advisor before you go on board with them. To me, a CFP is a must. I think a CFP is the level of expertise that you probably need to tie everything together. I also think going with an advisor that doesn't do one area of expertise and is specialized in dentistry is also to your benefit, because we know the business inside and out. But if they take an integrated, holistic approach, that would be a good start, where they're not just asking you, how much do you have to invest? Do you want to do insurance? If they're asking you, what are your debts? Well, how are you planning on paying this? What's your cash flow? What do you need to live? Like, these are important questions that feed everything else. Those are the foundational things you should really look for.
Yeah, I think a couple of things. Number one, it's definitely have somebody good that knows the dental market. Time and time again, when we sit down with each other, Steve or Josh will tell me, hey, Neil, what's going on with your supplies? Why are they above a certain percentage? Because they know the norms. And, either it's a mistake in a calculation, either we bought a lot of equipment that year, either we stocked up because we were afraid of the tariffs, whatever it may be, they pick those things up. The other thing is they know how the practice works. When there's leakage, when there's potential fraud, they catch it. When there's mistakes, they catch it because they know the numbers inside out and they have a big pool of database. For me, I'll tell you honestly, it's personality. It's that relationship. 27 years to be together, to see each other 3 to 4 times a year, and still together. That should be a testament. Other colleagues' referrals are always a good thing. There are a lot of accountants out there, but they're not going to know the nuances and details. Yes, there are a few out there that specializes in dental, and they're all good. Listen, what suits you? What is your personality, right? Do you like getting billed as a package every year and everything kind of dealt with, or do you want to get a bill for photocopying and stamps and an hour here and an hour there? Listen, that's your thing. That's your thing. What floats your boat, what you're comfortable with. This is a long-term relationship. You can't be flipping accountants, every few years and stuff. Yes, accountants die and you need to switch on to somebody else. But at the end of the day, you need a good relationship, and hopefully that accounting team also has a transition plan where, when one accountant goes, then another one can pick up the pieces and move from that because they know your story, they know your back end, and they know the succession planning that's taking place. Because that's one of the biggest difficulties in life, I think, is changing. And I don't like change personally. I like to stick with one, make it work and last. Right. So that would be my perspective from a dentist. It's what I look for.
Well, it's the same for us, Neil. Even as an individual choosing a dentist, right? There are now dentists on every corner, right? Referral always helps, and word of mouth. You got reviews that people do now, and social media is out there. We didn't even touch on social media today, but it's a big thing, and people, either overanalyze or look at all the things on social media. But to me, it's the relationship, right? The relationship you have, whether even for myself with the hygienist that you're with, or the dentist that you're going to, or for you, the advisor that you're dealing with. There are many good advisors out there, many good accountants, many good advisors, right? You have to feel comfortable that he or she is looking after your best interests and not their pocket, right? And that's the key. Everyone's got to get paid for what they do. Let's not be mindful or like take that.
Plus, it's tax deductible, Steve.
Tax deductible, Neil. Absolutely. All right, Jake, is there another couple there so we can
Yeah, there's a few that sort of base around the same question of what is the best way to use the retained earnings in the corporation? Should they invest it? Is there a better way?
And Josh touched on it earlier, right? I mean, there is. I mean, you have the ability once you start building up some monies inside the corporation, because now you've paid off your debts. Say you're a practice owner, you bought a practice, and now the debts are paid. Now you're noticing that there's money building up. When structured properly, the investment options are somewhat unlimited. You have to be mindful. Dental Professional Corporation has certain guidelines and constraints as to what you invest in. They want you obviously practicing dentistry and concentrating your efforts on dentistry. So, they don't want you opening up a Tim Hortons franchise and running that with the retained earnings. Invested in, whether it's stocks, bonds, things that are a little more passive in nature and not taking away from your main activity of being a dentist.
I'll jump in there because I'm seeing a lot of this. I'm seeing a lot of cash be built up and doing nothing for years for dentists. And it can be overwhelming to jump into the investment world because there's so much opportunity out there or so many options. But you just have to get started and you have to work with an advisor you trust, and it needs to be explained to you properly, like why you're investing, what are the goals, what's the expected range of outcomes, and what kind of risk you're willing to take and how that risk affects you on a daily basis or a yearly basis. You just have to have your money working harder for you, whether it's paying down debt or investing. Like those are the two major options, and neither one is a wrong answer.
Leaving it in the bank and not earning anything on it, the only one that is winning is your friends at the bank.
Mm-hmm.
Right? So you're potentially losing because inflation is hurting you and it's costing you in more salaries and more sundries. So even if you put the money to work, even if you put it in a GIC, if that's your comfort level, there's nothing wrong with that. It just means you have to save a little bit more and you might pay a little bit more in taxes, but do something with your money. Jake, any more before we touch off? I think we're getting to the point now where
Yeah, I think we'll end with this last one, and Neil can jump in as well. This dentist has a time horizon looking ahead about 15 years, and they're weighing to see what makes the most financial sense for them. If they should be an associate for these next 15 years, or to take on a practice and pay off the debt. That they feel that existing practice valuations can be absurd and aren't sure if the numbers make that much sense.
Sure, Neil, take a stab at it,
Yeah,
buddy.
no, listen, we're type A personalities. If you're comfortable working as an associate and you don't want any headaches in life and you're in the last 15-year horizon where you want to kind of, take the foot off the accelerator and enjoy life, it's an associate, there's perfectly honorable. There's nothing wrong with it, right? If you're a type A personality, you think, you want the little bit of excitement in your life, and unfortunately guys like me do. You want the daily challenges, you want the daily drama, you want the daily headache. Even though we don't like it, it keeps us ticking. And we like putting out fires at the end of the day, and get a practice, right? The reward is there, and then you have a team behind you to actually determine whether it's financially feasible or not. And if it is, listen, you're going to sell that practice down the road and still make money on it as well. And if you don't, you can drive it into the ground and you'll probably still end up making money in it. So it entirely depends on you. There are a lot of good deals out there. There are people that are retiring that want their patients being seen not by anybody other than somebody they've kind of vetted, and they're willing to let those practices go at a discounted rate for their patients and the continuity of care. A lot of these things are internal. It's good to have a pool of people that know about these opportunities. I've been offered a few of them through this group as well. Unfortunately, one is enough for me, but there are a lot of good opportunities out there. I would definitely touch base with these guys. They do have a few practices where dentists are retiring and they kind of want to leave and looking for a good associate.
Excellent. I think we'll wrap it up. I mean, there might have been more comments. Please reach out to us at info@tmfd If you have any questions or want to set up a meeting, or Neil, if you want to share your information, if you want to reach out to you, I know you've been very, very helpful with many of our clients that have looked for your guidance. So it is something that if someone want to reach out, I think it's easy to find Dr. Gajjar.
You'll definitely find me for sure.
Mhm.
And if not, they can get a hold of you, and by all means, you can share my contact information with them. That's not a problem at all.
Absolutely.
Fantastic. Well, thank you all, gentlemen, for your time and expertise. I feel like this was very valuable for everyone, and that's something to take away. Just a reminder that CE credits will be sent out within the next 2 weeks, and you will also be able to view a recording of this webinar on tmfd.ca. And TMFD Dental Academy will be hosting its next webinar on Wednesday, March 25th, titled AI in Practice, How to Assess Innovation Before Adopting It, presented by Amir Ahmed. You can register for that webinar by clicking on the link I've posted in the chat box or going to tmfd.ca. Thank you all for your time, and thank you, our guests. It's been really great to share this evening, and we hope you found it valuable.
Good
Thanks
night,
so much.
guys. Thanks,
Good
Neil.
night.
Thank you.
Bye-bye.